the Zambian tax system, the way taxation works. So this is not the main session, as I'll share a timetable, and then when I share the timetable, then you see the main session, and then the main session will include us starting again in terms of taxation. That's after you register, and then we start our share timetable, and then we get to learn everything. Okay, so let us start. So I've opened the past paper right now. Okay, let me just give you a tip. Okay, let me just give you a tip. If you want to be very comfortable with taxation, if you want to be in a very comfortable position with taxation, what you need to know is, number one, you need to understand the Zambia tax system, the way it works. Number two, you need to understand capital allowances. Um, and also the types of taxes, the VAT, the mineral royalty tax, uh, the income tax, the personal income tax, the farming income tax, the turnover tax, the rental income tax, and many more. You have to be comfortable with all those, okay? And also how different taxes relate to different types of businesses, and also presumptive taxes, okay? And also professional income tax. You need to understand all that. Okay, so let's get to understand what taxation is all about. Okay, and by the way, if you get to understand what I just gave you, then you'll be comfortable, because that's practically almost everything taxation. Okay, anyways, let's get to understand what taxation is all about. Okay, so taxation is a process by which the government, collects money from individuals and businesses to fund public services such as roads, schools, hospitals, and the national infrastructure. So the government gets money from you through your pay as you earn, through your income taxes, through your turnover tax, okay, through your withholding tax. And then once they get all the taxes from you, they'll use that money for them to fund public services, the roads, the schools, the hospitals, and any national infrastructure. Think of it like this. Taxation is practically the money paid to the government according to the law. So, according to the law, we are supposed to give a portion of our income or our profits to the government, or our income in employment to the government for. So basically, we are contributing so as to make our country better. The government gets money from us, and then afterwards, it gives the same money. It uses the same money to, build schools, hospitals, and make some roads. Okay, so let's look at the objective. Okay, people might have a question. The question might be, why is taxation important? Because most of the time we feel as though the government is just stealing money from us, so, and then they don't usually use it. But why do you think taxation is important? So this, I'm going to explain it, but I'll just bring it out as a question first. Mr. Sivajene, why do you think taxation is important?
Um, as to why taxation is important, um, well, I may be working from the it's the source of income for the government. I think I don't know from what point I can view it, like I can say it, but a source of income for the government to someone that funds the services like education, the free education. Really, I don't see any, but again, when I see it from the point of me as an employee, I think it's not really not a good thing, really.
Okay. All
Yeah,
right.
in terms
Okay.
of that.
All right. I think I'll just stick to what taxation is. Okay. All right, sir. So yes, so you are very correct. When the taxation actually helps us because it's a revenue generation for the government. Just like you see the company that you're working for, since you said you're an employee, the company that you're working for is doing something to earn money. This is what the government is doing for them to earn money. Okay, so they earn money through taxation so as to finance public services. Okay, so taxation, when the government gets money from you, it becomes a public resource, and then they're going to use that amount of money on public services. Okay, so it's practically revenue generation to fund public services. And then the other reason why we do taxation is what we call redistribution of wealth. So there's just the way it is. Okay, the more money you make, the more taxes you pay. Do you agree with me, Mr. Sibajane? The more money you make, the more taxes you pay. Like for instance, if it's an income tax business, okay, and then you pay income tax on your profit, the more the profit, the more the income tax. Okay? Or if it's a salary, the more the salary, the more the pay as you earn. Okay? So
Yeah, that's true.
yeah, so there is what we call redistribution of wealth. Okay, so taxation reduces inequality through progressive taxes. Okay, the more money you make, the more they will tax you. And then the other way that it reduces inequality is it gets taxes, more taxes from people who earn a lot of money and take it back to the community to people who don't earn any money. I'll give an example. They'll collect, if you're earning 50,000 kwacha, they'll collect tax from you, which is the money, and then they'll give it to someone else who is unable to work as, cash for work or basically any social welfare services. You get my point, Mr. Simajin?
Yes.
Yeah, yeah. So that's also redistribution of work. So the other reason is economic control. Okay, so taxation influences economic activities such as it encourages investments or consumption in specific products. Sometimes they might tax more some industry that might affect the environment. For instance, if you are importing cigarettes, there's a high chance they're going to tax you way more than the normal taxes, the normal products. They are practically trying to discourage people from doing that. It is legal, but they are trying to discourage people. You get my point, Mr. Siwa? So that's the way it is. So they are trying to control. Firstly, they're trying to control the economy, okay, economic activities, encouraging investments. Okay, lower taxes encourage people to invest in certain industries. I'll give an example how they encourage investments. Farming, if if you invest your money in a tourism business, you're going to pay income tax at the rate of 30%. Okay, if you invest your money in a tourism business, you're going to pay income tax at the rate of 30%. But if you invest your money in a farming business, you're going to pay income tax at 10%. You've seen it. There is a 20% discount because you're into farming. This is the government trying to encourage people to get into agriculture. Okay, so that's also economic control. Okay, they're trying to encourage people, they're discouraging people in some areas of the economy whilst encouraging them to join some other areas of the economy. Okay, and we can also we can actually link this to our next point, which is discouraging harmful activities. Mr. Siva, can you give me an example? Because I remember I explained one example of the discouraging harmful activities. Give me an example of how taxes can discourage harmful activities to the environment.
Um, so, for example, you've got in that industries that emit those emissions, carbon monoxide to the environment. So those are dangerous to the environment, and so I think in discouraging such businesses, they could get more or higher taxes than those that maybe do other forms of businesses, like you have said, farming.
Okay, perfect. Okay, so that's actually very correct. That's the way it is. So they'll tend to tax them more. Okay, so the tax might be maybe for tourism is 30%, and then the other people who are doing something that's a little bit crazy, they might charge them maybe 40% or 50%, depending with whatever they are doing. Okay, and then also they give what we call tax credits or a discount to businesses that do the government wants them to do. For instance, if a particular business has got more than half of its shareholders as Zambians, they always get a 5% discount. An example is you have 30%, let's say you pay 30% in income taxes in tourism, but imagine over 30% of the shares are owned by local Zambians. Then they're going to pay 25% instead. Okay, so they give discounts. Basically, they're trying to encourage companies to sell their shares to locals. You get it. They want the locals to own shares in these businesses. Okay. All right. And then the other thing is to promote social objectives. They offer subsidies or tax relief for things like education or health. Okay, so let's talk about the types of taxes. We'll definitely cruise through this paper. We'll get to look at the questions and I'll explain a number of aspects pertaining to this question. But right now, I'm practically just giving you the theory, which I'll definitely give you again as soon as we begin our sessions when I share our timetable tonight, and then we know when we are supposed to start. Okay, all right, perfect. So let's talk about the types of taxes. Okay. By the way, Mr. Amt, I think you should just send me a hi on WhatsApp. I'll be able to respond. Okay. All right. Let's talk about the types of taxes in Zambia. So we can categorize the types of taxes into two. Okay. We can categorize the types of taxes into two. The types of taxes that we can categorize them. Assuming you can see my screen right now, I think you're only seeing the paper. So here's what I'm going to do. I'm going to stop sharing so that I share my entire screen because I'm about to start typing on Excel and I want you to see what I'm going to type. Okay? Is that okay, sir?
Yes, yes, yes.
Okay. So I'm sharing my entire screen. Please do let me know when you can see it. Can you see my entire screen now?
Oh,
You
yes,
can?
yes, yes, yes.
Okay. All right. So I've just opened Excel. It's because I want to type the types of taxes. Okay. The types of taxes. Okay, so types of taxes. Here we are going to look at the general taxes, all the taxes that we have in Zambia. If we leave out one, we'll talk about it when our session starts, but mainly I'll give you examples. So I'll talk about the main taxes, okay? All right, so in terms of taxes, we have two categories. We have what we call direct taxes and we have what we call indirect taxes. So let me start with the direct taxes. Okay, so the taxes are classified into two: the direct taxes and the indirect taxes. So the direct taxes are paid directly by the taxpayer to the government. Okay, the direct taxes are paid directly. Let me just type it. Paid directly, paid directly by the taxpayer to the government. Okay, so these particular taxes are paid directly by the taxpayer to the government. Okay, I'll give you an example. Okay, I'll give you a few examples rather, not just one example. Examples that we can talk about are things like income tax. Okay, income tax. We know income tax is tax that is actually charged on your income. Okay, we have personal income tax and we have company income tax. Personal income tax is charged on your personal income, okay? The amount of money you make as an individual. And then company income tax is charged on your company, and the rates are very different. Personal income tax uses what we call a tax band. Let me show you the tax band. I'm going to go up right now. There's tax information on top. Every question that you have, by the way, there's tax information firstly. Um, so tax bands change every year. So this is 2024. These are the 2024 tax bands. But the good part is that Zika will always give you this information when you're writing. So just use, if in case it's different, just use the information in the paper when you're writing it. You get my point, Mr. Svatene?
Yes, 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 sure.
Okay, so we have these standard personal income tax rates. This is for an individual, and then we have income from farming for individuals, and then we have income company income tax. You notice that farming from individuals is 10% after the threshold, and then for a company it's also 10%. But you notice that everything else is at 30%. Basically, they're trying to encourage people to invest in farming. You've seen it. Yeah. So we have income tax. Income tax is an example of a direct tax. Example is pay as you earn for employees or corporate income tax for businesses. Okay, corporate income tax, we are looking at the company income tax. Pay as you earn, we are looking at the personal income tax. Okay, you earn a salary, you charge it pay, you use the band to calculate the pay as you earn. You earn income as you make a profit as a company, you use the company income tax rates based on the type of business. If it's a mining, 30%. If it's bank and the other financial institution, 30%. Farming, 10%. Manufacturing and any other that's not here, 30%. Okay, all right. So this is how we do it. Okay, so the first example of direct taxes is income tax. The other one we can say property transfer tax. Okay, we can bring in the property transfer tax. Okay, so this is the tax that you pay as a seller every single time you sell a property that you own or an asset that you own. For instance, if you sell a house, then you have to pay property transfer tax. For property transfer tax, we also use the tax bands. They're also in the question. There's PTT somewhere. Just a second, I'll find it. Okay, it's here, property transfer tax. So let's say, for instance, you sell a house at 50,000 kwacha. Okay, you sell a house at 50,000 kwacha. The value of the house is 60,000 kwacha. You're going to charge 5% on the 60,000 kwacha because ZRA always gets the higher amount between the market value of the house and the selling price or the proceeds. Okay, so these are the property transfer tax rates. And just like I mentioned, in terms of the personal income tax rates and the company income tax rates always change. So you have to make sure every single time, don't master it, make sure every single time you're solving a question in a past paper, use the information, the tax band information in that particular question. Okay. All right, I'll give an example. Turnover tax is no longer at 4%, it's now 5%. So maybe by the time you write, it will be 5%. But in this paper, it was probably 4%. It's under presumptive, you've seen, it's at 4%. You get my point, right? But currently it's at 5%. Right now, as I'm talking today, turnover tax is at 5%.
Oh, so even for these income tax bands, you don't have to use what you already know in your head. You have to use what is already in the question paper that is being given.
Yes, the best thing you can do is to know how to use them. That's the reason why
Okay.
they give you the information, because they tend to change. The information changes. So you have to make sure you know how to use them. That's the most important thing, how to use them, not mastering the numbers. Some information you might need to master, but mostly you have to, like, what you need to master, I'll be telling you is like, okay, this is not in the question. You won't find it in your paper. You need to know this. But all this information, you'll be finding it.
Sure. Thanks. Thanks.
Okay, so that's property transfer tax. That's also an example of direct taxes. And then let's talk about indirect taxes. Okay, indirect taxes. So let me tell you how indirect taxes work, okay, or practically what indirect taxes are. So these particular taxes are collected indirectly through purchases, okay? So these are collected indirectly through purchases. These are collected indirectly. I think it's this, yeah. These are collected indirectly through purchases. Okay, I'll give an example. An example, we can talk about value added tax. Value added tax. This is charged on goods and services. When you buy a product, you pay what we call input VAT. When you go, let's say, Mr. Sibajane, imagine this, you walk into ShopRite because you want to buy a particular product. When you buy that product, what you are going to pay is input VAT. You get it? It's charged on purchases. But you can only claim it back if you are a business. And that input VAT was a business cost. That expense was a business cost. But as an individual, you can't claim it. You definitely pay it, but you can't claim it. Okay? Yeah. So it's input VAT. But for ShopRite, it will be output VAT. For them, they cannot claim the output VAT. Instead, it's an expense that they have to remit to ZRA. Output VAT is a VAT expense, whilst input VAT is a VAT refund. So if we have more of input and less of output, we just find the difference, and the difference will be the VAT refund that we can claim from ZRA. But if we have more of output and less of input, then we'll have to find the difference, and the difference will be VAT payable, which we'll have to pay to ZRA. You get the difference?
Oh, okay.
Yeah. So VAT is an example of indirect tax that is collected indirectly through the purchases that you make. Okay. And then the other ones are excise duty. Excise duty is also an example of, I don't know, I just typed it. I was, now it looks like VAT excise duty. And excise duty, so excise duty is, there's supposed to be an E here. So excise duty is an example of an indirect tax, okay? Excise duty is an example of an indirect tax. This is tax on goods that we don't want to have in the country, okay? It's not illegal to have them, but we don't want to have them in excess. So charge extra tax. Example is things on like alcohol, tobacco, or it's touched on two things. Things that might affect the environment or people negatively, and also luxurious things. Like for instance, if you buy a Lamborghini, you pay customs duty, and then afterwards you pay excise duty, and then afterwards you pay import VAT. So, Mr. Sivajene, the next time you want to buy something from South Africa or from the US, holler at me. I'll tell you the taxes.
Okay. I see.
Yeah.
That's so. Uh, on certain items, you have to pay like a lot of taxes.
Yes, depending on the particular product. If it's a luxurious, you pay three things. You pay custom duty. After paying custom duty, you pay excise duty. Then afterwards, you're going to pay VAT, which is 16 import VAT, which is 16% of the total what we call CIF, which is the which represents the cost of you get the cost of the product, okay, and then you get the insurance of the product and the freight. The freight represents the transportation. It's like this. And as the freight represents the transportation, now let me say transport. Okay? Like for instance, how much money you spent to bring it here. So let's say for instance the cost is 20,000 kwacha, okay? And then the insurance is 5,000, and then the transport was 15,000. Okay? So we'll just get the total of all this, just make them currency, just show you how they're going to charge you at the airport. Okay, not at the the border. Okay, so it's going to be the total will be the total will be 40,000 kwacha. This is what we call the value for duty purposes. Okay, so now we're going to calculate the customs duty, but the customs duty mainly depends on what you've gotten. Okay, if you are to check, you notice that customs duty is the one that has got most information here. See, customs excise duty on used motor vehicles. There's this. You have to know the engine capacity of your motor vehicle and when it was manufactured, because that will affect the custom duty that they're going to charge you. And also, you have to know the type of vehicle. Is it a sedan? Okay. Is it a hatchback? Is it, is it a station wagon, an SUV? And once you know, that's when you can know the total custom duty. So I'll just take roughly. Let's say, for instance, it's an SUV with a capacity of 2,500. So we'll say it's 9024. That's over 5 years. Okay. That's over 5 years, meaning we'll pay 9024 in custom duty. Okay. And then we'll pay excise duty of 11,732. But because it's over 5 years, we always pay an extra fee. Okay. The extra fee is known as a surtax tax on all motor vehicles aged more than 5 years, which is 2,000. So now we have 2,000 extra. So if we were to go to our computation, if you want to know the total amount of taxes we pay, here's how we are going to do it. We're going to have custom duty. Okay. We're going to have custom duty. Our custom duty is going to be, I'm just going to pick it randomly. So 9,024. And then we're going to have excise duty. This is a shortcut. When we look at this, I'll show it to you in the correct format, but this is just a shortcut. Okay. So excise duty should be 11,732. Okay. And then once we have this, we'll practically just sum up everything. Because right now, what I want are our taxes. So when we sum up everything, by the way, by summing up everything, sum up everything, yeah, like this. Yeah, meaning we'll have 60,000. That's the value of the value we've spent on the product, the custom duty, and the excise duty. And then we'll have what we call import VAT. The import VAT will be on the total, the seven, like this, multiplied by 16%. And then afterwards, we'll We'll multiply this by 16%, it will give us the import VAT. Okay? And then afterwards, we sum them up. We sum them up, and then we bring in the surtax. This, which is 2,000. So if we got an SUV with a cylinder capacity of 2,500, the total cost that we are going to spend on that particular motor vehicle is 72,476.96. For the vehicle alone is 20,000. The insurance is 5, the transport is 15, and then we have the excise duty, the customs duty, the import VAT, and the surtax. And then the total import taxes will be who gets the customs duty, who gets the excise duty, who gets the import VAT, and then who gets the surtax as well. Okay? And then after we have all this information, we simply add it up. And by the way, Zika will give you about 9 marks to 10 for this. Just this, what I've done just here. And then it will be 32,476.96 as the total import VAT. Most of the time, Zika in their questions will ask you a question like, find the total VAT. Let me see if I can find something like that. Now, the total import taxes. Let me see if I can find a question like that. Okay, this is VAT. Yeah, I think it's this one. You see, calculate it's 7 marks. Calculate the total import taxes paid by Sichizia on the importation of the vehicle. It's exactly what I've done here, Mr. Svajani. Exactly. And then you get 7 marks, 7 free marks, right?
Yes.
Anyways,
Mhm.
okay, let's go back to our explanation. Okay, so we're just explaining it as an example of an indirect tax. Okay, we're just explaining it as an example of an indirect tax. So there are a number of key terminologies that we need to understand in terms of taxation. Okay, the number of key terminologies that we need to understand in terms of taxation. We need to understand what income is. When we talk about income, what do we mean? So when we talk about income, we're talking about the money or the benefits received by individuals, the money or the benefits received by individuals or businesses. For individuals, we're talking about salaries, rent, or interest. For businesses, we're talking about profits from trading. Every single time they are trading, the profit is an income. Okay. All right. So in terms of taxation, you have to be careful. Some taxes rather, are supposed to be charged on the sales, whilst others are supposed to be charged on the profit. Income tax is charged on the profit, or turnover tax is charged on the sales. So we have to be careful, and we need to understand all that. We'll definitely look at the taxes in details, the type of taxes, and then we'll get to break it down just like we've broken down the custom duty, excise duty, and import VAT as well. And then the other thing is we need to understand what we call allowable deductions. You know that every single time you are finding the business, I said there's income tax charge on the profit. Every single time you are preparing an income statement, you subtract expenses, right, Mr. Swajani?
Yes, that's true.
Yes, but what if certain expenses are taxable? Like for instance, if ZRA doesn't recognize a particular expense, meaning they will add it back, it's taxable.
Mm. What like how, what do you mean?
Let's say, for instance, every single time we are calculating our profit, we subtract depreciation, right?
Yes.
Okay, but depreciation is actually considered to be a capital expense. Do you know what a capital expense is, sir? Capital expense.
Yeah.
You know the types of expenses?
Capital expenses like one that is charged on on assets, capital assets.
Yes. So depreciation is considered a capital expense. So it is non-deductible. By non-deductible, we mean it is taxable. So it is subtracted when calculating profit, meaning when you are calculating the taxable profit, you need to add it back. Okay, that's the reason why this is how Zika phrases their question. Firstly, they'll ask you to calculate capital allowance all the time. Firstly, they'll ask you to calculate capital allowances, and then after you calculate the capital allowances, then they are going to ask you to you to calculate the taxable profit. See, here they are saying calculate the amount of provisional income tax, which is straightforward. And then here it's capital allowances. A capital allowance is a benefit that you are given because your assets depreciate. So you're not supposed to subtract depreciation again when calculating the taxable profit. That's the reason why we add it back. Instead, it's covered by capital allowances. You get my point, Mr. Swajane.
Oh, okay, okay.
Yeah, it's a benefit. So they'll always tell you calculate the amount of tax adjusted business profit. So to give you 12 marks, this is also straightforward, but this is you just making those particular adjustments. You look at the expenses they subtracted and the incomes they added, and then you make adjustments. Like for instance, depreciation, you add it back because it was subtracted.
Oh, okay. So it's like it's a benefit on the side of the company, not with the direct, right?
Yes. So depreciation on its own is taxable. Okay. What is not taxable is, okay, let me put it like this. Depreciation on its own is considered to be taxable. Why? Because the assets have capital allowances, which are benefits. So what we do is every capital expense, we add it back. And then at the bottom, we're going to subtract the total capital allowances. So the total amount here is what we are going to subtract instead of the depreciation. Anyways, don't worry, sir. You'll probably get it more clear the more when we start. Right now, it might look a bit strange, but
Yeah,
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 that's exactly
yes.
the way it is. And very soon you start looking at it the way I look it, even the way I look at it,
Sure,
probably even better.
sure.
Yeah. Okay, so we also have what we call taxable income. Taxable income, like for instance, this is what they're asking for. So this is the income on which tax is calculated after deducting allowable expenses or deductions. We subtract what ZRA is okay with as subtracting, and then afterwards our we calculate our tax on that amount. Now that amount is what we call a taxable income. Like this question is asking for a taxable income, tax adjusted business profit. You've seen it. And then we also have what we call the tax rates. The tax rates represents the information that you find on the first page. After the business, after the paper name, there's this information, taxation table. Okay, there's this taxation table. This is where you find the tax rates that you have to understand, not master, but you need to make sure you understand how to use these particular taxation rates. Okay. And then we have tax credits. Tax credits, these are practically more like discounts. These are amounts subtracted directly from the tax payable. Okay. Most of the time we have, let's say, a foreign tax credit, or maybe for personal income tax. Imagine this, Mr. Swajini. You are supposed to pay personal income tax, and we are calculating it using this, but you also paid withholding tax. So what we are going to do is, after we find your income tax liability, we are going to subtract your withholding tax, and then the total will be the expense that you're supposed to pay. So withholding tax in that case will be a tax credit, a deduction from your total income tax liability. You get my point? You paid it elsewhere on a different income, not on this one.
No, okay. So it's like it's deducted from the total tax expense that are supposed to remit. The
Yes.
okay.
Yeah, it's deducted. Okay. And then the other thing is, although this other thing is more of practical than theory, but I'll just mention it. That's filing. You probably won't do it when we are learning this, but you just need to know it because a question might pop up during the exam where they're asking you what happens, like the administration, how you do it. So you're supposed to file a return on the ZRIA website. Okay. You file a return, and when you are late, you get charged. Okay. You pay 2%. No, you pay 5% for late submission, 5% of the income tax liability, and then 2% plus the Bank of Zambia discount rate. The discount rate is most of the time different, but they'll always give it to you in the question. We'll get to look at that in details as well. But after you file the return, then you make a payment online. Back then we used to do physical payments, but most of the time now we do online. We're paying taxes owed within the stipulated deadline. If we pay a bit late, we'll get charged again. Okay, so let's look at the common taxes that we have in Zambia, and then afterwards we are going to close up. Like I said, this is just an introduction. Okay, so let's get to learn the common taxes. We have pay as you earn. Okay, so pay as you earn is employees, is for employees. Okay, so this is a personal income tax that is charged, that is actually paid rather by employees. It's monthly deductions from the salary. Okay, and then we have what we call company income tax. Okay, so company income tax. So companies pay a standard rate of their net profit. Okay, so this is income tax paid by companies. Okay, so this is income tax paid by companies. How are you going to know the rate? You need to know the type of company it is. Like for instance, manufacturing is 30%, farming is 10%, mineral processing is 30%, mining operations is 30%, banks and other financial institutions is also 30%. But you get the rate from here. Okay? All right, so that's, yes, you can ask.
So how often does this tax paid? Is it after every after the company publishes their financials?
Okay, so now let me explain it to you in details. Okay, I feel I was supposed to explain it to you in details when. Okay, so this is actually paid quarterly in a year. There's what we call provisional income tax. So provisional income tax is, let's say for instance, we are in 2025 and then we don't know the amount of profit to make for 2025. So instead, we estimate our tax, our profit. Let's say, for instance, we said, okay, it looks like we'll make 50,000 quarter profit. And then we start paying provisional income tax of that amount quarterly. Every after 3 months, we pay a portion of that. You get my point? We
Yes,
estimate
yes,
our
yes.
profit and then we pay every after 3 months using a tax year, which is the same as your calendar year from January to December. Okay, so we'll be paying every after 3 months, and then when we pay, the rate will be based on the type of company. If it's mining, it's 30%, the professional income tax. So we'll pay, usually we pay 3 times in a year. The last one is when the year has elapsed. So the last one will be we know the profit. And then afterwards, what we're going to do is we are going to calculate our total income tax liability. And then afterwards, we'll subtract the total provisional income tax that we have already paid to find the expense,
Oh, okay,
the
okay.
remaining balance. The reason why ZRA does this is to make it a bit easier for companies to pay and also to ensure they don't have a massive liability when they're done with their financial year.
That also applies to the same turnover taxing.
No, no, no. Turnover tax you pay it monthly on
Oh,
the 14th of the following month. It's it was at 4% until this year they changed it to 5.
you say turnover is paid on revenues.
Yes, turnover tax is paid on revenue. Whilst income tax is paid on profit.
So you are charged on revenue and also on net profit on
No, no,
profits
no, no, no.
after.
If a business is paying turnover tax, they don't pay income tax. For businesses that pay turnover tax, they earn 800,000 kwacha and below.
Oh,
So all
okay.
businesses that earn below 800,000 kwacha in a year pay turnover tax. And all businesses that make over 800,000 kwacha in a year pay company income tax.
Oh, okay, okay. Thanks.
Yes. Okay. So that's the second one, the company income tax. The next tax that we have to understand is VAT. So which is our value added tax. Okay. This is actually paid by businesses. It's the standard rate is 16% on taxable goods. Okay. So it's paid on taxable goods and services. So in terms of VAT, we have two rates. We have the zero rated VAT, which is 0%, and then we have the standard rate, which is 16%. And then we also have some products and services that are exempt. Okay? Some products 16%, they're standard rated. Some products are zero rated, and other products are exempt. We'll get to look at VAT in details as well. And then we have withholding tax. Withholding tax represents the tax that we pay at source. Okay, let's say for instance you offer a service, a consultancy service, and then you are supposed to get 20,000 kwacha in commissions, or basically as a consultancy fee, and then you get 15,000 kwacha instead because 5,000 kwacha was withheld. So withholding tax is paid by the company that's supposed to pay you money. You receive the net instead. You will only recognize it when you're calculating your personal income tax. You subtract it because you already paid it. It was paid by you, but it was remitted by the person who was paying you. You get my point, Mr. Sivajan?
Oh, okay. So it's like like you don't get the tax, but the other company withholds it.
Yes, that's
Then
what it's called withholding tax. They withhold it and they remit it to ZRA on your behalf. Instead, you only receive what we call a withholding tax certificate.
oh, okay, okay.
Yes, but you recognize it as your expense. It will then reduce your personal income tax liability.
Oh, okay, okay. Oh,
So it's
okay.
paid on,
Interesting.
let's say, commissions, dividends, and royalties or consultancy fees, but there are some more, but these are the common ones. So the rates are different, but the standard rate is 15%. And some things are affected, like for instance, bank interest. If you gain interest from the bank on fixed deposit, if it's an individual, then it will be 0% withholding tax. But if it's a company, then you pay 15% withholding tax. And then for dividends, if it's on a loosely registered company, the withholding tax rate is zero. But if it's on a company that's not under LOSE, the withholding tax rate is 15%. And then on commissions, if it's for a resident, it's 15%. But if it's for a non-resident, it's 20%. So what affects these rates are things like, is it loosely registered or is it not loosely registered? Is it for a Zambian or is it for a non-Zambian? Is it for a company or is it for an individual? So every single time you see this, you have to ask yourself that question. But not to worry, we'll look at withholding tax as an entire topic because it always comes in your papers. Okay? And then we have custom duty. Okay, so custom duty is basically on importers. Okay, so it's charged on imports. It's part of the import taxes. You remember when I put in the custom duty, excess duty, and import VAT? You remember that, right?
Yeah, yes, yes, yes.
Yeah, it's part of the import taxes. So it's charged on imports. How to charge it? We use the information. Remember the type of vehicle, if it's a vehicle, most of the time it's vehicles. The type of vehicle, the engine capacity, such things, the manufacturing date. Yeah, yeah. Okay. All right. And then we also need to learn what we call principles of taxation. Okay, like for instance, equity taxes should be fair. Like for instance, those with more money pay more money, and also certainty. Tax rules should be clear, and then it has to be convenient. Tax payment should be easy, and then they have to be economical. Cost of collecting taxes should be very low. And then afterwards, we just get to understand how the ZRA works, because there might be a question that's asking you on tax administration. Like for instance, the departments in ZRA and their functions. So we need to get to understand that as well. Okay. So in brief, we can say taxation, is all about mandatory payments that we make to the government. Okay, a way to fund services, control the economy, and practically redistribute our wealth. Okay, so you have to make sure you understand the direct taxes, indirect taxes, pay as you earn, VAT, company taxes, how to file, compliancy, and then you have to know the principles of a good taxation system that ensures fair and efficiency application of the tax system. Otherwise, that's it on the introduction. Do you have any questions? And how was the session?
It's been interesting. I think on question for me, I think I still need to digest this. Yeah,
Don't
it's quite
don't worry.
interesting.
Yeah, it's very interesting, and there's a secret. Okay, if
Yeah,
you want to be good at these Zika subjects, I'll tell you my secret. Do you want me to tell you my secret?
this
You have to love it. That's it.
okay.
Yeah, just have interest in it. So remember I made a video about the key, what you're supposed to do for you to actually clear a Zika subject. Number one, you have to ensure you read the material, you understand the material. And number two, you have to make sure you practice the material. You are comfortable with the material. You practice it. You solve actual Zika past papers. You get a paper and then you literally start solving. You don't read financial statements. You solve them. Okay? Create a format. Do the dirty work. Do everything. And then lastly, you have to make sure you develop interest in the subject. You love it. And then that's it. You'll be comfortable with it.
Sure.
Yeah. Okay. But otherwise, Mr. Amt, do you have a question? You have a question? How does the Zambian versus UK tax system work? Okay, the Zambian versus UK tax system work. Okay, in terms of the Zika taxation, the tax system is slightly different. Okay, you might find there's a slight difference in terms of the rates. I think everything else is the same. The only difference is in just around how much. Yeah. So everything else, I believe, is the same. The only difference might be the rates, but otherwise, how we apply the VAT, the withholding tax, how we apply the income taxes, the turnover tax, everything else is the same. And also, there is what we call double taxation agreements. I believe Zambia and the UK have got a double taxation agreement. So let's say, for instance, in terms of withholding tax, their rates are way lower than the normal withholding tax rates because they'll be charged in their country as well. Okay. Um, Mr. Victor, thank you for joining us, though you are very, very late as we are about to close.
Okay, thank you.
Okay.
Uh,
Right. But I'll send to a recording in the group. Just ensure you watch it. But otherwise, the session, I believe, has been very insightful. You should definitely look at it.
all right, sir. I'll do as soon as we finish.
Okay. All right. Otherwise, thank you very much, team. For today, we end right here. I'll wait for the timetable as I'll share it in the main group. Okay. And if you're joining our session so that we get to look at this even more in detail as we prepare for our exams, please just inbox me. Okay. So that the action actually begins. Thank you very much. My name is Ronald Kashweka.
Thank you. Thank you.